Giancarlo, Jerry, we miss you guys when we're not here. Thank you so much for being here for the live tonight. We appreciate you. Have a happy holiday and get some rest. The rest of this year is about to be crazy. Welcome, ladies and gentlemen, to the Compound and Friends presents What Are Your Thoughts? Is that right?
Sure.
Kinda, sort of?
I like it.
Well, like on the audio, it's going on the Compound and Friends podcast feed.
Yeah.
So, all right. We're back. And tonight's show is going to be off the chain. So much to discuss. With me tonight, as always, is my co-host, Mr. Michael Batnick. Michael, say hello.
Hello.
Duncan's here. Daniel is behind the boards, helping to control the show tonight. No Nicole this evening, guys. And we'll certainly miss her in the chat. But I want you guys to feel free to get rowdy in the chat. There's no policeman tonight. So you could basically get away with anything. I don't know who's going to jump in here and do anything about it, quite frankly. So knock yourselves out. Tonight's show is brought to us by Public.com. Michael, what can we say about Public?
Public is a brokerage house where one of the things...
It's really like a lifestyle, I feel like.
That's a way. One of the things that you could do now... So 2023, it was all about cash, right? Get some yields in your cash. 23 and 24. Now, going into the new year, it's all about the yield in your bonds, right? Cash is not hot anymore. The Fed is cutting. We know this. Interest rates at the longer end of the curve are rising. You could take advantage of that. Easy peasy, lemon squeezy. You can get some corporate bonds, easy, clickety clack, Apple, Microsoft, whatever you want at Public. Got over 6% now. Not bad.
Yeah, the bond account does it for you. So you don't have to pick and choose corporate bonds. Public built this thing to enable people to take an off-ramp from cash and still find a way to get higher yields. And of course, it's a different type of risk. It's corporate bonds versus treasuries. We understand this, but you guys should read more about it at public.com. This has been brought to you by Public Investing, member of FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account, greater than 6%. Yield to worst is not guaranteed. Not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more information, or just go to public.com/WAYT, as in, what are your thoughts? Okay. The market caught Bessent fever this week. Yeah? People are excited. We got a Bessent bump.
I'm excited. I just found out about this guy, and I'm already excited.
Let's put him on screen. How come we're not in the hedge fund world. We've never talked about him. I've only heard the name in passing. Now, all of a sudden, the world is awash in Scott Bessent experts.
Yeah.
It's kind of interesting, right? Where were all these people?
Apparently, I would consider, we're like one of the assholes that are just discovering this guy. Apparently, he was featured in More Money Than God by Sebastian Bach. Not Sebastian. What was the guy? Sebastian Mallaby,
Sebastian
right?
Bach?
I was about to say younger. Sebastian Mallaby.
Mallaby.
Yeah, one of my favorite investment books of all time. I don't remember him being in there, but this guy was a chief investment officer for Soros, launched the biggest macro hedge fund at the time when he did so, storied career on Wall Street, and everything that I'm seeing, I'm happy about it. This is the chief financial officer of the United States, and he seems to be a serious person with serious ideas, and I'm optimistic.
How many people on earth do you think have worked directly with Stan Druckenmiller, George Soros, Jim Rogers, and Jim Chanos? Zero?
One.
Safe bet?
Yeah, one.
One.
Well, I don't know, maybe a few others, but yeah.
So that's the first thing. The second thing, we listened to Ted Seide's excellent interview with Scott. Ted worked with Scott at Protege Partners a generation ago, and some of the stories that Scott Bessent was telling about being involved in the Soros trade where he shorted the British pound, being involved with Jim Chanos in the late 80s, and then shorting the savings and loan crisis. He was very heavily invested in the Abenomics trade where the yen got killed and Japanese stocks went up huge. Like, he has been investing and early investing in some of the biggest macroeconomic trades of the last 40 years. We've never had a Treasury Secretary who I think understands stocks, commodities, currencies, fixed income, and economic policy.
And the narrative.
So I agree with you. Like, I think the Bessent bump is warranted. I know a lot of people are already shit talking, like whatever he's saying about tariffs. It's kind of his job to spin what Trump wants to do, but the hope has to be that he has Trump's like attention and can say, "What if you didn't do this and you did that?" Like, right?
Trump respects him. He's a billionaire. So Josh mentioned the Ted Seides interview, which was great. Talks a lot about his background. If you want to get a flavor of some of his current ideas, he was also on stage with Mike Green talking about some of his like not political, just his policy ideas and some political stuff, which I thought was also worth listening to. So I'm excited. Listen, this is a very, very important role. The economy is front and center. It's the most important thing to most people, probably most people watching. So I'm happy with this choice.
Let's go to this note.
Which one?
Okay. Take us through what's in here.
So this is from, chart off. Let me just set this up. Note off for a second. So this is a letter that he wrote to his hedge fund investors in early January 2024. And he laid out some ideas for how the market was going to go. And one of the things, and I love seeing Neil Dutta's research in there. One of the things that was counterintuitive to me, again, I'm not a hedge fund billionaire manager, this guy was, that I thought was like, oh, I never thought about it this way. So there was a great chart that Neil Dutta did showing what happened when Trump was ahead in terms of the voting polls, like in terms of who was going to win, versus when Biden was ahead. And when Trump was ahead, the stock market performed really well and vice versa. And he showed the cumulative spread and it was impactful. And I would have thought like, oh, okay, so the market is looking forward to a Trump presidency, more pro-growth, more deregulation, But actually the opposite was true. He was saying, no. When Trump is leading the polls, Yellen and Powell would be more likely to have pro-growth policies because they want the market to do well in an election year because they are, listen, most of the existing people in Washington were not Trump voters, okay? So they thought that when Trump was ahead, they were going to do more to support the economy and the market.
Oh, it would force them to tack more toward pro-market policy.
Exactly.
Oh, that's interesting.
Because they said that like in an election year, they would be more likely to let inflation run hot than have a recession. So that like counterintuitive narrative I thought was very interesting. So he laid that out, and I would assume that he had a very good 2024 based on some of the policy choices that he was making. Okay, so anyway, so table back on, or note back on. So he talks about the Roaring '20s as he sees it, and just allow me for a second to read this. He said, our base case is that a re-elected Donald Trump will want to create an economic Lollapalooza and engineer what he will likely call, quote, the greatest 4 years in American history. Economist Ed Yardeni believes that post-COVID America has a potential to have a boom similar to the Roaring '20s of a century ago. We believe that a returning President Trump would like this to be his legacy. In this scenario, the greatest risk factor, in our opinion, will be a sudden rise in long-end rates. The talk of revenge will likely be limited to a small group of political enemies, and the wider policies of the administration will be oriented toward deregulation, energy independence, and reviving U.S. manufacturing and extending the tax cuts. We find it unlikely that across-the-board tariffs, as currently reported by the media, would be enacted at the same time as he moves to fix the immigration crisis. The tariff gun will always be loaded and on the table, but rarely discharged. Of course, strategic and national security issues around China will remain. We'll get back to the tariff stuff in a minute because obviously that was front and center last night with what Trump tweeted. We'll get back to that. But last, I want to end with this because this is really the coup de grace of the note. Another differentiated view that we have is that Trump will pursue a weak dollar policy rather than implementing tariffs. Tariffs are inflationary and would strengthen the dollar. Hardly a good starting point for a U.S. industrial renaissance. Weakening the dollar early in a second administration would make U.S. manufacturing competitive. A weak dollar and plentiful, cheap energy could power a boom. The current Wall Street consensus is for a strong dollar based on the tariffs. We strongly disagree. A strong dollar should emerge by the end of his term if the U.S. reshoring effort is successful. All right, I apologize for reading all of that, but it's important because this is a note to his investors, okay? This is not like a note to like...
this was written a year ago.
So yeah. This was his investment thesis. This wasn't like, oh, I want to be Secretary of Treasury. This was his investment thesis, and it played out pretty strongly. So what are your thoughts on some of that stuff, Josh?
Well, the way I put it, he laid out 3 macro ideas for 2024 last January, and all 3 of them came true. He pointed to Japanese raising bond yields actually being stimulative. And, most people, they just assume like, oh, lowering rates is stimulus. No, it isn't. It only took us 15 years to figure that out post GFC. So he said that about Japan, and that proved to be true. He also said that all of the onshoring, reshoring stuff in America, actually, it would be expensive at first and maybe a little bit inflationary, but would ultimately prove to create more capacity and therefore be disinflationary. That's proving to be true. So that's 2 things. And then the first thing he said was that Trump would win. And he got that one right too. So he made 3 really big macro calls in January of last year. It's 11 months later. He nailed them all.
Yeah.
To varying degrees, but I like the idea of somebody who thinks in markets and bets as opposed to somebody who thinks in what soundbite is going to play well on Twitter, being in the spot. We talked to Sembalist last Monday about Janet Yellen being MIA, and that being one of the biggest messaging problems of the Biden administration. Maybe it goes beyond messaging. I don't think she is paying attention to stocks and bonds. I don't think that ever mattered to her, quite frankly. So this guy is hyper-focused on, I think, this is our base case is that a reelected Donald Trump will create an economic Lollapalooza. Well, fuck yeah.
Hey, let's do it.
Who doesn't want the economic Lollapalooza?
Yeah.
One of the things he said with Ted that I really liked is that he thinks the new Republican Party in the wake of this election, and he said this on election eve, but he thinks the new party is this coalescence of the working class and business leaders. And then, of course, in between, you have a lot of people in the middle class, the overly educated, the intelligentsia, journalists, academics who are not part of that. So he's just talking about this idea. He's been poor. His father was a real estate speculator in South Carolina. He had a boom and bust childhood. I think he's saying a lot of the. I don't want to glaze this guy for an hour. I think he's saying a lot of the right things in these early innings. And I think the market likes it, I guess, is where I would fall on this.
Everything that we've heard, this guy's not like a political Looney Tune. He's not an ideologue. He's got ideas, and he wants to serve the country and grow our way out of the debt. And listen, let's hope that everything that he says comes to pass.
One other thing I would say, I know we have some charts, but one other thing I would say. Having somebody, here's what's interesting. Having somebody as the Treasury Secretary that a lot of people on Wall Street know is also really interesting. So Yellen obviously is like a Fed lifer. Okay, fine. Not necessarily a known quantity in terms of relationships all over the street.
He's an academic.
Yeah, which is perfectly fine. No disrespect to Janet Yellen at all. It's just she's not this. Mnuchin was more of an investment banker. This guy, people working in the industry have had a lot of real life experience dealing with him in a business context. So, and he just seems accessible. He's doing everyone's podcasts except for ours. So he's a known quantity on Wall Street. So I think that's good. But I also think he's going to have a Bloomberg on his desk. And if Trump is doing crazy shit that's really starting to leave a mark, I think he's going to speak up because he thinks he knows better.
All right, well, that's a great segue.
It might get him fired, but
that's a great segue to this tweet from Sam Rowe. So Sam tweeted this from Deutsche Bank. Will tariff policy respond to the equity market again? Over several rounds, escalation saw equity sell-offs, which then prompted de-escalations, especially after declines of about 10%. Scott Bessent understands this chart and hopefully will be able to tone down.
Wait, I don't understand this chart.
It's showing
just the S&P 500 during the last trade war.
Yeah, and it's showing periods of escalation and de-escalation. Of course, escalation was not good. De-escalation was good in terms of ups and downs for the market. And then last night you saw Trump truth, or whatever we're calling it. Chart off, please. About 25% tariffs on everything imported from Canada and Mexico. And the market didn't really respond as you might have thought. And I don't know if the market's looking past what he's saying, but like to Bessent's point about using the tariff gun as negotiating, it seems like that's what the market is thinking. Of course, we have like a long way to go.
Yeah, the market has figured out the game. Trump, and we've said this before, Trump's first book was called The Art of the Deal. There's a whole chapter about his negotiating strategy. And he likes to walk into the room and punch the other guy in the face.
Yeah, so the market
That's how he opens the negotiation, and maybe it's effective. We've seen that be effective. Look, the tariffs last time were an unmitigated disaster, and there were a lot of backdoor shenanigans with like the farmers. He gave the farmers $28 billion over 2 years to repair the damage from China not buying our soybeans. That's, I don't know, to put that number into context, that's like the entire budget of the U.S. State Department over the course of a year. Like he had to fix his own, he wouldn't call it a mistake, but like I think he knows that across the board tariffs actually do more harm than good. So I think that the market has figured this game out too.
Well, next chart. So this is from Goldman. So we're looking, for those of you who are listening and not watching, we're looking at PCE for all core goods that were not impacted by the Trump tariffs, and the inflation went down. And then it's showing the PCE prices across 9 tariff impacted categories, and the prices went up obviously because tariffs are inflationary.
Yeah, and there's stuff with the steel industry where nobody in the United States benefited from the steel tariffs, like all of the downstream jobs that were affected. Like it was not successful, but that doesn't mean waving them around like a cudgel in terms of rhetoric
could be effective.
Be successful.
Yeah. So anyway, the fact that we've got a Wall Street guy, a Main Street guy, somebody that understands the market, the economy, currencies, that Trump respects, is objectively whatever political side you were on before the election, you should be happy about that.
I want to give a shout out to Larry Delavine from Reuters. His byline is Lawrence Delavine, but I always call people Lawrence. I call them Larry. He wrote about Scott's actual performance at the hedge fund itself.
Do you see what happens, Lawrence? Do you see what happens?
You see what happens, Lawrence? So there was one episode where there was a 90% decline in his hedge fund's assets or something, which is the thing that a lot of people on the left are throwing out in response to people saying nice things about him, which I understand. That's the game. But if you look at the entirety of the track record, so just like to pull out a couple of stats that aren't terribly meaningful, but just interesting, I guess. He launched Key Square in 2015. They raised $4.5 billion, which is one of the largest hedge fund launches in history. That included $2 billion that Soros gave him. The returns were about 13% in 2016, which was their first year, which a lot of hedge funds got wrong. They were betting on Brexit being this like disruptive event, negative event, and it didn't work out that way. They lost 7% in 2017, which was a great year for stocks. Oh well, broke even from 2018 to 2021.
Wait, he lost money in 2017? I take back everything I said.
No, he lost 7% in 2017. But then double digits in 2023 and 2024, it looks like. And the fund is up double digits over its history since inception.
I could look past that. The last decade for global macro investors has been really hard.
2022, which was a meat grinder for everyone, he was up 30%. So that's what a hedge fund's supposed to do.
Right.
Is what I'm the point I'm trying to make. So he knows his old business, and let's hope he knows his new business.
Amen. Okay. All right. So it's a bull market. I don't know if you knew that. And one of the features of a bull market, not just this most recent episode of the bull market, but for the last 10 years, are obvious signs at the top. One that just came to my mind was was it Elizabeth Banks who was doing the mid-cap commercials for State Street? Yeah. And then what did Mila Kunis say? What did Mila Kunis do that was signed at the top of 2013?
Like venture investing, maybe. I feel like she was or the Ashton Kutcher is
no, Mila Kunis. There was a Mila. It was so long ago, but there was a big hoopla, a brouhaha on FinTwit back in the day because Mila Kunis rotated into Apple or some shit. I can't remember. But the point is, The point is, there are so many obvious signs of the top that we just like forget about because whatever, they just fall by the wayside. So let's look at some of the most recent ones. And by the way, it's not to say that this can't be a top because, who knows? Like just because there's a magazine indicator cover doesn't mean it has to mark the exact top as long as it's within the vicinity, which let's just get to it. All right. So Dan Greenhouse with the S&P 500. By the way, love Dan, but come on, Boomer. Why are you hashtagging SPX and SPY? With the S&P 500.
Did somebody tell him we're still doing cash tags?
Yeah, what is happening?
We're not doing cash tags.
There's 2 cash tags and then the S&P 500.
And they're both for the same thing. They're both for the S&P 500.
So with the S&P,
super boomery,
basically at an all-time high, it's appropriate. It is appropriate yet to wonder where have all the people gone who were warning about the Fed draining liquidity? Weren't we reliably told what has happened couldn't happen? And what Dan's talking about is cash added or drained from the banking system, and they tightened the shit out of the banking system, and the S&P 500 did not care. We, of course, had a couple.
This was a sign of the top. He just posted this today, or
no,
last week.
He's saying what happened to all the people that were saying don't fight the Fed.
I don't remember that, maybe because I wasn't on Twitter, but people were saying that the Fed is draining liquidity from the banking system.
The Fed tightening should have been bearish for the S&P. That's all. Of course.
But how is that a sign? How is that a sign of the top? I'm missing the connection.
Can you just stop
please,
talking for a second? All right. How about a couple of weeks ago when there was the NVIDIA watch party? That was supposed to be a sign of the top. Okay. Sam tweeted NVIDIA's up 17% since the earnings watch party. If you rewind a little bit further, when Jensen was signing the bra, I'm sure it's up even more since then.
Yeah.
Most recently, we have the Haktua girl thanking Michael Saylor to launch to buy Bitcoin, which probably is a top. Let's be honest. No, just kidding. Who knows? My point is,
God, this is a thing that happened.
Well, and also I just saw like 20 minutes ago, she's launching a meme coin. Which, by the way, shouldn't these meme coins not be legal? I know like everything's legal these days, but.
No, but more of them should be legal.
Anyhow, my point is, a bull market doesn't just stop because people are doing dumb shit. You could argue that people have been doing dumb shit for the last 11 years.
So the Dan tweet doesn't really fit into this paradigm, but the other two I get. One of the things that I would say is that no matter when the market tops, you and me will, because we have great memories and we're living in this thing, 3 months after it tops, we will be able to remember immediately whatever the craziest shit that happened was at the top. And then we're going to say, see, that was the top. But your point is, all throughout the year, at bottoms, in the middle, at tops, there's always stupid things like the Haktua girl saying thank you to Michael Saylor. It's just like one of these things where if you're investing based on quote unquote signs of the top, you're not a serious investor. I
remember this now. This is from 2013, and you and I remember this because we were together at the time. Mila Kunis rotates from cash to stocks. Remember that was the headline on CNBC.
Yeah, if you sold that, how you doing?
I mean, that was the S&P at 1,000.
The better example from 2013 was the unicorn cover in Fortune, where they said there are 30 privately held venture-backed startups worth more than $1 billion.
We were all laughing.
Now there's 200 of them. So
how about the show Silicon Valley? If there's ever a sign on the top, they made a show about Silicon Valley, and that was 4,000% ago on the Qs.
Yeah, I like that. I think it's like really easy to go back after the market tops and be like, we should have known, but then you're ignoring all the things that weren't the top. Although if the Haktua girl interviews Scott Bessent this week, I'm probably going to sell something. I don't know what, but I'm probably going to lighten up a little bit. I don't. By the way, I don't really hate her. I feel like she has a big personality, and people think she's fun.
She's fun. Who hates her?
Oh, people are like mad that she's like all of a sudden the most famous person in the world. I'm not mad.
People are mad about everything.
People are mad. I did some skeets. Can we put them up on screen?
That's what they're called?
I don't know. I don't think I'm even allowed to say that, to be honest with you. Here's a skeet that I did. Just
stop saying that.
All right. This is year-to-date corporate buybacks as a percent of market cap, on pace for an all-time record. accelerating into year end. Look, you could say that we're at the top, but then you would be saying that these people are all idiots, accelerating their buybacks into the end of the year when they should be like preserving cash or whatever. So the corporates are undeterred by the fact that this market is up 20 some odd % year to date, and they're buying more.
Sorry, not to nitpick. This is not a percent of anything. You skeeted that, but that's the 4-week average millions. It's not
included into the data though is the fact that it's also a record.
Oh, okay.
As a percentage of market cap, but the chart is showing actual dollars.
Got it.
This is from Chart Kid Matt. My next skeet. I don't know. It's at the top. Third quarter earnings season is as good as you could have asked for if you wanted to justify the rally that started this September. S&P 500 profits were up 9%, which was almost 500 basis points better than what we were expecting going into the quarter. 75% of companies beat. That's usually 77%, so right around the average. Sales were up too, so it's not just manipulated earnings, quote unquote. And 8 of 11 sectors posted higher profits. The one sector that was like noticeably negative was not really that negative. It was the energy sector.
Can I ask you a favor? The next time you throw your skeet onto a screen, can we please at least see the chart, for God's sakes? This is horrible. This is malpractice. Thank you, Daniel.
Spoke too soon, motherfucker.
Thank you.
How do you like that?
I love it. Okay.
So energy is just going to have volatile earnings all the time. Obviously, it depends on the price of oil and gas. But away from that, like this is what you want to say is the top? All right. So all of these bars are going to be lower next quarter, next year. You know what I mean? So all of the thank you. Chart off. All of the $6 million banana taped to the wall, all that stuff, it's fine. Maybe we'll look back on it and say we should have known, but probably not.
I mean, I think this is. Nobody would say this is not a raging bull market. So don't mishear us, right? Like this is a raging bull market, and there are pockets of mania, like no doubt about it.
Guys, on Blue Sky, there's only one downtown Josh Brown, and that's my handle. If you see one that has an extra N on the end of Brown, that's not me. And that's me. Michael. Don't buy crypto from whoever that is. What are we calling financial Blue Sky? Somebody said Bluefin.
Oh,
and then I liked Butterfly. Because like you know how the symbol is a blue butterfly? I kind of liked Butterfly. I don't know. We'll see what I don't like Fin Sky because when you write it out, it looks like Finsky. It doesn't look right. We'll have to figure that out. Have you sent any skeets, sir?
I sent one today.
You scatted?
I scatted. It was my the Spider-Man, the Otto Octavius meme of him saying it's about to stabilize or something. And I said, this is Michael Saylor when MicroStrategy hits its $47 trillion.
Are you having fun there a little bit or not yet?
There's only so many hours in the day. I don't have time for this.
I predict you will be a high volume skeeter very soon. So
okay.
I predict you do have time. All right. Here's a new investment idea I wanted to run by you. So one way to, I think about asset allocation, you know how people like, they're like, 1% gold sleeve or like maybe crypto, 1%. Just anytime you hear people talking about a Ponzi scheme, you should have a sleeve in your portfolio where you just buy it. Just in case it's MicroStrategy at $20 a share.
It's a pyramid. It's not a Ponzi. And
first of all, it's a Ponzi built on top of a pyramid. But just buy it anyway, because what if you're completely wrong and it's not that? I think like instead of saying, you should have a Bitcoin sleeve or you should have a DeFi or just, you know what? The minute people start calling something a Ponzi, the crowd is probably wrong and just buy it. And if it goes to zero, who cares? It's a small sleeve. If it 20Xs and you want to kill yourself, at least you own a bunch of it and you made some money. So I'm thinking about maybe a very rational decision for the modern asset allocator in the meme stock age is a Ponzi scheme where it doesn't really matter. Don't do any research at all. Just if people are saying this is a Ponzi, It might not be. It might be MicroStrategy.
So
it
finally, you're learning.
Just buy the pawns.
Yeah.
What? Why? Think about it. Think about where we are right now and the way things work. It's like bordering on lawlessness going into 2025. Like, we're basically going to be in a situation where anyone who wants can launch anything, and people are like deliberately looking for the wildest swings in the things that they operate. This is going to be a situation where maybe you buy 10 things and 9 of them are Ponzi's, and the 10th one goes up 20,000% and pays for all of the losses and then some. So
I think like unironically, and I'm being serious, a lot of people are doing that.
I think unironically they are.
Yeah.
And I think that makes more sense than what the hell is a 1% gold sleeve going to do for anyone?
Right. Yeah.
Like, gold's not going to 10x. So what's the point of that?
How about this? Playing the meme market that we live in, whether it's crypto or levered ETFs or whatever, is probably a lot better and frankly more fun than doing angel investing. No?
Okay. So
no? Answer my question.
Yeah. So if that's the world that we're in, this stuff's liquid. So if Hawk Tua launches a token and like it runs up to $5 billion in value, which of course it will, and everyone's on social media going like, this is a Ponzi scheme because here is the formula for, I fucking buy it. Okay, sure. Maybe you're right. What if you're not? So this is how I'm starting to think.
Let me ask you this. Does it make you mad that Michael Saylor called his shot and then hit a home run?
No, I'm not mad. I'm mad at myself. I didn't buy any. This is what I'm trying to rectify. You understand? I'm not mad at all. I think
there's a difference between like,
it's amazing.
I think the Michael Saylor situation very specifically is super interesting. I think it's the craziest thing I've ever seen. But also, like, he said what he was going to do. He laid it out. And there was a lot of sophisticated people on Reddit that understood what he was doing with the option pool and all that stuff. And it worked. And so I think that a lot of those people understandably get pissed off at people like us who are like sort of making fun. It's like, you guys are so smart. Like, okay, I made 4,000%.
They were right. Listen, it might collapse, but it hasn't yet. And they make more money like literally every passing week. So they were 100% right in taking it seriously. We didn't take it seriously at all.
No.
We didn't even bother to. We didn't. So I think this is my point. Most things that everyone is saying that is a Ponzi scheme probably will turn out to be Ponzi schemes. Some won't. So now, are you smart enough to really do the work and do the research? I don't really want to. So I'm thinking about maybe just like, all right, listen, we'll see what happens. You're so smart. Where's your $1 billion, Twitter guy?
And let me also just say for the record, I don't actually think that Josh is advocating that people start spraying money.
I don't advocate anything for anyone. I'm talking about for myself. I don't care what. There's literally no one I care about what they do. I don't police other people's recreational trading. I am saying for me, the next time everybody tells me, "Oh, see this Ponzi scheme?" Yeah, hang on one sec. Let me just get long. Can we talk about Ben Carlson selling Bitcoin?
Sure.
Put up Ben's chart. I thought he made a good point here. He's not a no coiner. Ben bought in 2017 right after I did, and he's held it all this time. And I think he's taken profits a little bit along the way. But he's
this is the first time he sold. It's the first time he sold.
Oh, but he's doing so, I think, in a very measured way, where he's just like saying, "Look, this is about regret minimization for me."
Yes.
And I'm not making a call on where I think the price will go. I'm making a call on how much it's up relative to the rest of my portfolio. So I thought he said I came close to selling in 2021, and then he didn't sell at 70,000. It dropped back to 20,000. So now it's here at 90,000. And he said, you know what? It's 10% of my entire portfolio. It's too big.
Yeah.
So he's taking it back to
soft.
5. And
so soft.
But what this chart is showing, it's not a price chart. This is showing the drawdowns back to the inception of the thing. And, Ben's basically saying like, maybe it doesn't get this bad again as it has before. But remember how many times it's gone down 80%. Mm-hmm. And don't think that's impossible. This would be really painful if it did this again. for Wall Street at this point, right? So $3 trillion and 80% drawdown.
That'd be bad.
That'd be pretty bad.
It would be bad.
Okay.
Something really bad would have had to happen for that to.
Anyway, that is the Midwest's approach to Bitcoin ownership.
Now listen,
And
whether it's
I respect it.
whether it's Bitcoin or any other stock or whatever that's appreciated, like nobody knows where the top is, and Ben's 100% right. It's about like what can you live with, whether you're right, you're wrong, it goes up, it goes down, and there's no right. Listen, that's personal, right? Whatever's best for you, that's what you do.
Well, so here's what he's not doing. He's not counting up all the nodes and the volume and coming up with a formula for what fair value is for a Bitcoin. That's not what's going on. What Ben's saying is like, okay, that's enough for me.
Okay.
And I'll still own some, but I don't need to own this much.
Respect.
And totally rational. If you're not like hardcore into this shit, but you just don't want to completely miss out, that sounds like it's the right mentality. It's like, when is enough for me personally, given how much risk I want? And I wanted to applaud Ben. Shout out to Ben. So
Okay, where are we going next? Oh, let's do some charts. All right, so I think we'll pat ourselves on the back a little bit. In 24, certainly. I don't know when exactly it started. Actually, at the end of 22, I know exactly when it started. The tech stocks bottom on December 31st, 2022. And they went straight up in 2023. And they went straight up for the first half of 24, not the second half. But Josh and I had said a lot, listen, don't worry about the breadth. Not because we're telling you not to worry, but only because it's not as if the rest of the market rolled over and it was just 7 stocks. If that happened, we would not have been saying that. We would have said, this is what happened in 2000, and maybe we should chill out.
you're not saying don't worry about the breadth. You're saying don't worry about the concentration.
Yes. We were saying like, it's not like the rest of the market's doing shitty and it's only a few stocks. It's, these 7 stocks are doing amazing and the rest of the market was up 8% through the first half. Like it was fine. So anyway, all of the worries have corrected to the upside. Chart on, please, from Chart Kid. So you've got the price on top, the S&P 500 price, and you've got the cumulative advanced decline confirming the price.
Look at this.
Confirmation. It's all coming together. Next chart, please, from Y Charts. We've got the S&P 500 up 20. I made this, I think, yesterday. The S&P 500
Bang!
Up 27% year to date. Look at the equal weight. The equal weight was up 20%. The equal weight. Look at next chart. We're going to run through some large. So large divided by small. This is kind of interesting. So on the left, you've got a long-term view. And look at the right. You've got, so large divided by small is rolling over, which shows that the Russell 2000 or the small cap 600 in this case, which hit an all-time high yesterday, the market is it's broadening. The rally is broadening. It's not just mega cap, which is something that you love to see.
Wait. What? So large cap relative to small cap. On the left side, we're looking at the long-term trend, which is obviously large
Higher.
cap outperforming small. Of course,
Yes.
we all know. In the right chart, that's rolling over in a shorter-term time frame.
Yep.
Okay.
And I hate to show bullish charts in a bull market, but whatever. That's what it is. Next chart. Equal weight staples. These are the most defensive areas of the market, both the long-term and the short-term. Equal weight staples are getting the crap beat out of it by the rest of the market, which is what you want to see in a bull market.
It means allocators are getting less defensive in what they're buying.
The defensive stocks are underperforming. Next, what is the most economically sensitive area of the stock market? It's industrials. Confirmation. Long-term and short-term. This is the equal weight industrials relative to the equal weight S&P 500. What else do we got here? Next chart, financials. So of course the long-term looks disgusting because 2008 there was a little event that happened. But look at the short-term. Look how we blew past the SVB crisis. This is the equal weight financials divided by the S&P 500 equal weight. This is extremely bullish, and that's all I have to say about that. Listen, this is not a forever thing, okay? This is like eventually this will run out of steam. But you have to make money in the bull market. You have to make money in the bull market.
Look, in 2023, the FANGs ran away with the cake, and a lot of people were saying the rally's too concentrated. Like that was the mantra. It's like, oh, it's just 7 stocks. That's the first time we started saying the Mag 7 and the S&P 493.
And it was mostly true. It was
That's
mostly
the origin,
true.
and it was true. But the thing that we said on this show 50 times was that every time over the last 15 years that we've had these like, it's a divergence,
Yeah.
they have resolved to the upside with maybe two exceptions. Like on two occasions we had a correction, but for the most part, like 100 times, those mega versus large versus mid, small, those divergences, what ended up happening was the rest of the market ended up catching up. And did you know that financials are actually the best stocks in the market this year as a sector?
I did.
The entire market, the entire sector, 95% of the components of the S&P financials are now above their 20-day moving average.
What's not?
The entire sector is on
FTX?
fire. Yeah, FTX is the only laggard.
Speaking of, let's talk about Gensler's legacy. So Gensler is stepping down, and Nate Rossi had a wonderful tweet for listeners. It's the meme of somebody pointing into the mirror, and it's Gary Gensler looking back saying, "You protected investors." And my God, is the opposite true. This guy's legacy is a disaster. Arguably,
You understand he's still our regulator, and he's 100% coming to your house.
my house.
I would assume you're the one talking shit. I mean, you are aware that
Had there been an ETF approved back when the Winklevi applied for one, which was like 2012, 2014 maybe, or even 2017 or even 2019, a lot of the crime that we saw probably, almost definitely, would not have taken place if there had just been an ETF.
All right. There's an alternate universe where in 2017, when they first started seriously filing for ETFs, okay? So by 2017, Bitcoin comes out in 2008. 2017, the problem is we get all these ICOs, which are the original shit coins, which are like IPOs, but it's people doing coin drops. I think 99% of them are frauds or scams or rug pulls or pump and dumps. It was bad. And he's the top cop at the time, and he's not. Jay Clayton is there. He comes in with Biden into an even worse environment. 2020, 2021 is an even bigger carnival. He's got Tom Brady and all kinds of celebrities hanging out with SBF, who's making political donations to get himself into his office. Like it's a Wild West. I think Gensler kind of erred on the side of all of this is bad versus trying to like figure out what's the least bad way to allow this. I think it was just easier to say, no, we're not allowing any of it. In my opinion, it turned out to have been the wrong fight, because if you have an ETF in 2018, 2019, 2020, you'll have ups and downs and people will still get hurt by the price of Bitcoin, but it probably obviates the need for there to be an FTX and a Binance.
You think? And how about all of the money incinerators that have come to market under the past, whatever, X number of years, between the SPACs and the levered this and the levered that, and the fact that we couldn't just get a spot Bitcoin ETF, but we had a futures. I mean, just come on.
Okay, but I just want to point out, Gensler is not the person that denied the first applications of spot Bitcoin ETFs, because he wasn't there. It was Clayton in 17 during the first Bitcoin boom. So it's important to remember, this is the longstanding policy of the agency. It's not like he's the first person to come into the SEC and say no Bitcoin.
So what?
I do think that, look, people really hate him, and they like claim he's corrupt and like he's owned by the traditional financial system. I don't think any of that's true.
I don't believe any of that. I think he was trying to do a good job.
I think he really, right. I think my personal opinion is he just really believed that the existing securities laws more than covered most of this activity. And as a result, it wasn't for him to change the rules for them. It was for them to come into compliance. The legitimate complaint is that he just sued people rather than negotiated or met with them. And I think that just comes with a democratic regime and a more democratic mindset versus a Republican mindset of, no. Like
they were complaining that it was policy by enforcement.
Yeah.
So I don't think that he was, a bad guy or anything like that. I just thought that the policies were bad.
Well, there are people that really genuinely think that he was like he had personal vendettas against Brian Armstrong.
It appeared that way.
And at Coinbase.
It did appear that way.
It from the outside, and if you just like follow the stories on Twitter, it sort of did appear that way.
How about just shutting down Silvergate?
Yeah, the Ripple thing, like I think it's still in court. It's like 7 years of suing people. It from the outside. And what that did, here's what that did. And I understand the intention was to stop people from violating securities laws. And I respect the SEC's mission, and I do think that that's good for the investor class. So that's the intent. Here's the effect. It keeps Fidelity from going all the way into doing clean version of crypto brokerage. It keeps Schwab still not in the game. Like Schwab has nothing in crypto. So it keeps the two biggest brokerages, one of which really wanted to do this right, on the sidelines. It keeps the ETF issuers away from putting out decent products. And I think it kept the traditional media away from really like discovering like these stories. Like CNBC kind of and Bloomberg, they had to cover it, and the FT, they had to cover it skeptically because the regulators were saying this shit is all illegal. And so it probably set back a lot of innovation in the space that would not have been harmful to the public. So it's just one of these things where I really believe that it was well-intentioned. And then it got to a point where it's just like, all right, why are we still doing this? Like there's 50 million people in America who own crypto at this point. What are we protecting them from?
Right.
They fucking want to do it. They want to own it. So like, can we make constructive lanes for them to own it?
And again, you're 100% right. And the yes, you could buy this. No, you can't buy that. It was a bunch of malarkey. One
of the stories about like regulatory overreach that people frequently cite in the early 1980s when Apple was coming public, the securities regulators of the state of Massachusetts said Massachusetts residents are forbidden from buying Apple, which eventually became the largest company in the world. Now, you could have bought it the day after the IPO, no problem. So it's not like they really stopped people from investing in Apple, but like banning the IPO in the state. And you know what the reason why was? Do you know why they said no Apple IPO in this state? You're gonna laugh. Think about how quaint this is. The company was not profitable yet. I mean, can you fucking imagine? But the puritanical idea about whether or not investors should be able to buy a money-losing IPO, I guess in the early 80s that made sense to people. And I'm sure there were all kinds of op-eds being written about why they were doing the right thing by stopping it. What really happens is time marches on and things in the rearview mirror, it looks like, wait, really? It looks like the priest in Footloose who wouldn't let the teenagers go to the school dance. Like no dancing. Like that's what it ends up looking like in hindsight. So it's a complicated legacy, I suppose, of his tenure.
Okay. Go ahead. Let's move on.
Making the case for you.
You're making the case for me.
Here's two of our old friends from the post-pandemic.
Hello, darkness.
You got to choose one.
Well, I already own one. So
to get long. All right. Let's do Zoom. So they just reported earnings and the stock fell 5%, but it's still well within its uptrend. And I wouldn't be surprised if it reverses higher. Here's the next one, DocuSign. This one looks amazing right now.
Wow.
Yeah. What up? I just want to catch you up on the story. DocuSign hit a 52-week high, I think today or yesterday. It's up 95% over the last 12 months, making it one of the best performing stocks in the market.
Wow.
And 7% year-over-year increase in revenue. They hit $736 million in revenue. Non-GAAP operating margins 32%, $200 million in annualized free cash flow. Let me see what else. 40% growth in non-GAAP operating income year over year in this quarter. And they launched something called the Intelligent Agreement Management, or IAM platform. And I think that's probably AI, if I had to guess.
Who cares about the fundamentals?
All right. I'm just saying the fundamentals have turned positive, and that's coinciding with 52-week highs for the stock and a double in the price. I see in the chat, DK Gong says Kathy Wood must be happy. Is that one of her names? DocuSign? ARK is rallying a little bit, right? Lately. And I'm sure this is helping a little. Anyway, that's DocuSign. The next one is Zoom. Sean put some slides in here.
I did.
You did. All right. Very slow growth, but growth nonetheless. What are you showing us here?
DocuSign is not one of our top 10 holdings. I definitely used to be. Let me see the full holdings. All right, so what we're showing here is Zoom is not really growing that much, but maybe it's good enough. Total revenue is up 4%. Their enterprise, like their giant contracts, what does that say? Up 8%. They have a 98% retention rate for the larger clients, the customers that are over 100K. Not bad. So I own Zoom. I bought Zoom.
192,000 enterprise customers is a big company.
Yeah, it's just not growing that much because everybody bought it in 2020 and 2021. So look next chart. Let's look at some of the valuation compression. So this was the dumbest stock in hindsight in the pandemic.
God.
It was bigger than Exxon. This is the price to sales ratio hit 120. Next chart, please. It's now down to 5.6. This is just zoomed in a little bit. So the excess has clearly been washed out. The stock has been working. I bought it and I sold it before the recent rally, which was fun. But I bought it. Yeah, it happens. You know what?
I've done it
because, dude, we're in a bull market. It's the only stock that I own that's not working. Get out of here.
I was in this stock earlier this year, and I didn't make any money. I sold at break even.
So it happens. So I bought Zoom 2 days ago on the dip and the snapback. So yeah, I own Zoom. So there you go.
A couple of people in the chat are saying that Zoom and DocuSign should merge. I said that 2 years ago.
I don't hate that.
When these stocks were at all-time lows. They're very complementary. We actually use Zoom as a company, and I talked about this on CNBC today. They provide our phones and text messaging for our entire firm, and they archive all our texts, which is a regulation in the investment business. And people think that it's the video business, and they're just competing with Teams and Google Meet. No, they're selling software into the enterprise that does a lot of other things, and video is just now a part of it. In fact, they just said today they're changing the name from Zoom Video Communications to Zoom Communications. The corporate name. So
DocuSign chart looks incredible. I won't buy it. That's why it's going higher. There's a big fat gap all the way up at 165, which is a double from here. So for the longs, I hope it works. But yeah, it looks great.
DocuSign's going higher, but I think I would buy Zoom. I think I want to see if it's going to come close to retesting that 50-day.
Yeah.
Which
here's the deal.
74.
Zoom just reported earnings today. It wasn't great, but it got bought up at the end of the day. We'll see. It's just one day. DocuSign has earnings next week, and given that the stock just ran from 60 to 90, basically, maybe it's got some give back. Who knows? We'll see.
Yeah.
Right.
Which one would you pull the trigger on right now?
I own Zoom. I bought it this week, so that's my
you're
answer.
back in it?
I bought it 2 days ago.
Okay, good answer. I think that's the one that I would do too. Joe Altamoro in the chat says throw in Ring Central. I'm glad you brought that up.
What's
we
the ticker
fired
there?
Ring Central.
What's the ticker?
Who cares? It was terrible. We fired them.
Does that go in the Ponzi sleeve?
No.
Ring set. Okay. All right. I got a quick mystery chart. Then we'll get out of here. First chart, please, Daniel. This is a long-term chart, obviously, of the price of a stock.
Is it a stock?
It's a stock. That is good. The next one is a little bit of a more zoomed in look. There we go. So this is over the last 5 years. Does this look good or bad?
It looks amazing.
Okay. This is an important company.
It looks extended.
Okay.
But amazing.
Okay. This so we see it. Chart off, please. This is an important company. One of the top 10 most important companies in the country. Hold on, I'm almost done. It has I believe it's the #1 revenue generator in the country, and I'll stop there.
Walmart.
Yes.
I am the smartest man alive. Respect my gangster.
I mean, I give you.
Come on, bro.
Dude, listen to me. I throw you
Come
an
on,
alley.
say.
I throw you an
You're
alley
smart,
oop.
Josh.
When I throw you an alley oop, you're allowed to say good pass.
Good pass for sure.
Thank you.
But also respect my gangster.
All right, good dunk.
All right. Hey, guys, thanks so much for watching and listening. We really appreciate everyone who shows up for the live. And we will be back next Tuesday, 5 p.m. Eastern. We want to wish you all a very happy Thanksgiving. I also want to let you know tomorrow is Wednesday, which means an all-new edition of Animal Spirits, my favorite podcast, with Michael and Ben on all podcast platforms, YouTube later in the day. There will be no episode of The Compound and Friends on Thursday because Thursday's Thanksgiving. So consider this my sign-off for the week. We love you. We'll talk to you soon.